Welcome back to Supernova. In this video we are talking about investments in stocks, bonds, and other investment vehicles. Investing can be a great way to grow your wealth over time, but it can also be confusing and overwhelming, especially if you're new to it. In this video, we'll cover some basic information on how to get started and what you should consider when investing your money. Number 1. Understanding the basics of stocks and bonds. Stocks and bonds are two of the most common types of investment vehicles available to investors. While both offer the potential for growth and income, they differ in several ways. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company, which gives you certain rights, such as the right to vote on important company decisions and the right to a share of the company's profits. Stocks are typically more volatile than bonds, meaning they can experience bigger swings in value, but they also offer greater potential for long-term growth. Bonds, on the other hand, represent a loan to a company or government entity. When you buy a bond, you're essentially lending money to the issuer in exchange for a promise of regular interest payments and the return of your principal investment when the bond matures. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. In summary, stocks represent ownership in a company and offer higher potential returns but come with more risk, while bonds represent a loan to a company or government entity and offer lower potential returns but are considered less risky. As an investor, it's important to understand these basic differences between stocks and bonds to make informed decisions about how to allocate your investment portfolio. Number 2. Determining your investment goals. Determining your investment goals is an important first step in the investment process. Your investment goals will depend on your personal financial situation, your age, your risk tolerance, and your time horizon. Some common investment goals include building an emergency fund. If you don't have one already, your first investment goal should be to build an emergency fund. This should be an easily accessible savings account that can cover 3 to 6 months' worth of living expenses. Saving for short-term goals. If you have any short-term goals, such as buying a car or taking a vacation, you should save for these goals in a low-risk investment vehicle, such as a savings account or a short-term bond fund. Saving for retirement. One of the most common investment goals is saving for retirement. Your time horizon, risk tolerance, and retirement lifestyle will all play a role in determining how much you need to save and where you should invest your money. Saving for education. If you have children or plan to go back to school yourself, you may want to save for education expenses. There are several tax-advantaged investment vehicles, such as 529 plans, that can help you save for education expenses. General wealth building. If you have extra money to invest and no specific goals in mind, you may want to focus on building wealth over the long term. In this case, you should focus on a well-diversified investment portfolio that matches your risk tolerance and time horizon. Determining your investment goals is an important step in the investment process because it helps you focus on what you're trying to achieve and develop a plan to get there. Once you have a clear understanding of your goals, you can begin to choose the right investment vehicles and create a well-diversified portfolio that can help you achieve those goals. Number 3. Choosing the right investment vehicle. Choosing the right investment vehicle is an important part of the investment process. There are many different investment options to choose from, including individual stocks, mutual funds, exchange-traded funds, ETFs, bonds, real estate, and more. Here are some factors to consider when choosing the right investment vehicle. Risk tolerance. Your risk tolerance is an important factor to consider when choosing the right investment vehicle. If you have a high risk tolerance, you may be comfortable investing in stocks or mutual funds, which can offer higher potential returns but also come with more risk. If you have a low risk tolerance, you may prefer to invest in bonds or other lower risk investments. Time horizon. Your time horizon is the amount of time you have to achieve your investment goals. If you have a long time horizon, such as several decades until retirement, you may be comfortable investing in more volatile assets, such as stocks or real estate. If you have a shorter time horizon, such as a few years, you may prefer to invest in lower risk assets, such as bonds or cash. Investment goals. your investment goals should also guide your choice of investment vehicle. For example, if you're saving for retirement, you may want to invest in a tax-advantaged retirement account, such as a 401k or IRA. If you're saving for a down payment on a house, you may want to invest in a lower risk asset, such as a bond fund or savings account. Fees and expenses. The fees and expenses associated with different investment vehicles can vary widely. It's important to consider these costs when choosing an investment vehicle, as they can have a significant impact on your returns over time. For example, mutual funds and ETFs often charge expense ratios, while individual stocks may require you to pay brokerage fees. Diversification. Diversification is the practice of spreading your investments across different asset classes, sectors, and industries to reduce risk. It's important to choose investment vehicles that can help you achieve diversification in your portfolio. For example, mutual funds and ETFs can offer exposure to a broad range of assets, while individual stocks may be more concentrated in a particular sector or industry. In summary, choosing the right investment vehicle is an important part of the investment process. Your risk tolerance, time horizon, investment goals, fees and expenses, and diversification should all be considered when making your investment decisions. By choosing the right investment vehicles, you can build a well-diversified portfolio that can help you achieve your investment goals. Part 4. Diversifying your portfolio. Diversifying your portfolio is an important strategy to reduce risk and increase potential returns. Diversification involves spreading your investments across different asset classes, sectors, and industries to reduce the impact of any one investment on your overall portfolio. Here are some reasons why diversifying your portfolio is important. Reducing risk. Diversification can help reduce the risk of your portfolio by spreading your investments across different asset classes, sectors, and industries. This can help to mitigate the impact of any one investment on your overall portfolio, reducing the risk of losing a significant amount of money. Increasing potential returns. Diversification can also increase the potential returns of your portfolio by allowing you to participate in the growth of different sectors and industries. By investing in a mix of asset classes, you can potentially benefit from different economic cycles and market conditions. Balancing risk and return. Diversification can help you find a balance between risk and return that is appropriate for your investment goals and risk tolerance. By investing in a mix of assets, you can potentially achieve a higher return than investing in a single asset class while also reducing the overall risk of your portfolio. Improving liquidity. Diversification can also improve the liquidity of your portfolio by investing in assets with different levels of liquidity. For example, stocks are generally more liquid than real estate, so by investing in both asset classes, you can have access to cash in different time frames. When diversifying your portfolio, it's important to consider the different asset classes, sectors, and industries that you want to invest in. You should also consider the different risk levels and potential returns of each asset class. Some common asset classes for diversification include stocks, bonds, real estate, commodities, and alternative investments. In summary, diversifying your portfolio is an important strategy to reduce risk and increase potential returns. By investing in a mix of asset classes, sectors, and industries, you can potentially achieve a higher return while also reducing the overall risk of your portfolio. Part 5. Staying informed investing. Staying informed is an important part of investing. It involves keeping up to date with the latest news and trends in the financial markets, as well as monitoring your own investments and their performance. Here are some reasons why staying informed is important. Making informed investment decisions. By staying informed about the financial markets and economic conditions, you can make more informed investment decisions. You can analyze trends and data to identify potential opportunities and risks, and adjust your investments accordingly. Monitoring your investments. Staying informed also involves monitoring your investments and their performance. This allows you to track the progress of your investments, and make changes to your portfolio if necessary. By regularly reviewing your investments, you can ensure that your portfolio remains aligned with your investment goals and risk tolerance. Managing risk. staying informed can also help you manage risk in your portfolio. By keeping up to date with news and events that may affect your investments, you can identify potential risks and take steps to mitigate them. For example, if you own stock in a company that is facing regulatory challenges, you may want to consider selling that stock to reduce your exposure to that risk. Taking advantage of opportunities. Staying informed can also help you take advantage of investment opportunities. By keeping an eye on the financial markets, you can identify potential investments that may be undervalued or overlooked by other investors. This can give you a competitive edge in your investing. To stay informed, there are several steps you can take. These include reading financial news and publications, following reputable financial experts on social media, attending investment conferences and seminars, and monitoring your investments regularly. It's important to gather information from multiple sources to get a well-rounded view of the financial markets and avoid relying too heavily on any one source. In summary, staying informed is an important part of investing. It allows you to make informed investment decisions, monitor your investments, manage risk, and take advantage of opportunities. By staying informed, you can maximize your investment returns and achieve your investment goals. Conclusion. In summary, investing in stocks, bonds, and other investment vehicles can be a great way to grow your wealth over time. By understanding the basics of investing, determining your investment goals, choosing the right investment vehicle, diversifying your portfolio, and staying informed, you can make more informed decisions about how to invest your money and achieve your financial goals. Thank you for watching. Like, share and subscribe to our channel. We will see you on another one.